Today's Pacific West Mortgage Fund podcast is brought to you by the Granger Company, a full-service commercial real estate firm specializing in the leasing, sale, and property management of commercial real estate in the Southern California area. Today we have an exciting topic. We're going to be discussing probably the most relevant topic for commercial property owners and lenders in the market right now, which is insurance. And I have with me today Michael Esparza from Brown & Brown Insurance in Santa Barbara. And I also have Hanna Granger with me, who is dealing with a lot of our insurance for Pacific West. So, Michael, I want to really thank you for coming all the way down from beautiful Santa Barbara.
Yeah.
It's very nice to see you. We buy a lot of insurance, and Michael has been handling this for us for the last couple of years. We had a real scare 2 years ago because we simply couldn't get insurance. A lot of our insurance was going up 200, 300, 400, 500% in one case. So Michael, I just want to start off with a few kind of basic questions and then maybe get into some of the more complicated, things that are happening in the insurance market. So just in general, what are the biggest challenges as a broker that you're finding right now in the marketplace?
Yeah, well, thanks for having me, Mark. We have a little bit of a lot of things going on right now in the insurance marketplace. I mean, we have natural disasters, we have insurance regulations, we have carriers leaving California, as you well know, and this is all really leading to skyrocketing premiums.
Yeah. So we've, of course, the fires we've heard lots about, probably more than any of us can handle right now.
Yeah.
But do you think that these fires and natural disasters, the ones that have happened just most recently, of course, this has been sort of an ongoing thing for the last seems like the last 4 or 5 or 6 years with, the fires in Northern California and then these local fires. Do you foresee more of these agencies or insurance companies actually pulling out of California?
Yeah, it's a good question. It's tough to see what exactly is going to happen in the future, but the reason that and how we got here is really twofold. The California Insurance Commissioner is Ricardo Laura, and he's really at the center of all of this right now, and he's taken on a lot of heat, but really a lot of this started back when Proposition 103 passed in 1988, and it did a lot of things. But two of the things that it did is, one is it made that position an elected position for the insurance commissioner, and two, it made rates harder to be increased by the insurance carriers, and that really led to a couple things we'll talk about later, but one of the things it led to was a really challenging marketplace for insurance companies to make money. So in 2023, it came out that insurance carriers are paying $1.11 for every dollar that they're taking in. So that's not a good business
Well, that's not going to last very long, obviously, right?
Yeah, so you have that component, and then you also have the other component, which is the obligations that the admitted carriers have to the California Fair Plan here. So those two things really have driven a lot of insurance carriers out of the marketplace here in California.
So you, Dad and Michael, you brought up climate change and the fires and insurance rates going up. How do you foresee the LA wildfires affecting property insurance rates in the future?
Yeah, so it's going to hit us, but not right away.
Okay.
I would say it could be 6 to 18 months on that. And the reason that is because like you have insurance carriers have insurance, right? And that's a very simplistic way of talking about what's called reinsurance.
So that's reinsurance that you're talking about, right?
Exactly. So that's reinsurance. And the reason it might take a little bit of time is because those policies are written on usually a 2 to 3 year basis. So we want to see if things flatten out a little bit. Let's say we have a clean rest of this year and next year. We could potentially see a plateau in rates, but surely the LA fires, I mean, those were substantial losses, so it will hit. It will, but it's a matter of when.
So what about other natural disasters, like in California, like earthquakes, or around the country, like hurricanes or flooding in Louisiana or Florida?
Yeah. So of course, things like flood are always a possibility here in California because we're not really built for a ton of rain. Things like earthquake, it's always an elephant in the room, right? We have clients who are more risk adverse that move forward with that, but that's always kind of elephant in the room.
I mean, you can't
when the
even
big
buy
one's going to
earthquake
happen
insurance right now, can you?
It's pricey. It's pricey for sure, but we've seen options come out that are reasonable. But I think something that you touched on that's important is that we're not just isolated here to California and wildfires. What happens across the nation, it has an impact here on the California market as well, because those are all the same carriers, the same reinsurers that are involved there. It's going to be hitting their books as well. So that's also important to take note of.
Yeah. Do you foresee there being problems with non-renewal, or just people not being able to get insurance from these earthquakes and fires?
We're seeing more non-renewals than we've ever seen. And we're seeing reasons for non-renewal, something along the lines of, we are non-renewing your policy because we want to non-renew your policy, right? There's not a ton of rationale behind it. Yeah. So in the event that you do see non-renewal, I mean, we are seeing those, as you're mentioning, 2, 3, 4, 500% increases. But that being said, you can always go to the California Fair Plan in the event you can't find anything or have no options.
Yeah. Can you talk more about that? Because I know a very limited amount about the California Fair Plan.
The California Fair Plan has always been known as a carrier of last resort, and it was never meant to be a permanent solution. What it is a very basic policy that covers property only.
No liability.
No liability on it, and it is on what's called a named peril basis. What that means is it's going to name the specific perils that it covers, the main one being fire. Don't worry, you'll have lightning coverage as well, and internal explosion, and but what you're really purchasing it for is that fire insurance. What you really want is a broad form policy, which is going to tell you specifically what's excluded, and then after that, everything's going to be included. So whether a tree falls or you have water damage or a automobile running into your building, that's what you want to be covered. But again, the Fair Plan is going to be that very basic form.
So let's just say, for argument's sake, that you have a commercial piece of property, and you have California Fair Plan because nothing else is available.
Yeah.
So I actually had this happen on an industrial building one time. We had a very severe forklift operator accident. It was a huge deal, multi-million-dollar lawsuit. Would Fair Plan cover you on any of that?
So just a couple specifics about the details of the claim. A lot of times you got to remember too that it's not going to be liability.
Right.
So if someone's going to have property damage or bodily injury to a third party, that's where your liability is going to come in and pick up. But in the event that, someone else's forklift runs into your building, there's going to be no property coverage under the California Fair Plan on that.
Okay. So you're really very, very limited to what this covers then.
And the California Fair Plan, I believe, has written about 500,000 policies as of date. That's how many policies they have written, which is more than double what they had in 2020. Now, because of the insurance carriers leaving and this being an option for a lot of individuals, as we see the increase in popularity, we're also seeing products come out, namely a wrap policy that pairs with the California Fair Plan, and that allows you to become more whole to what you're used to with your coverages. It's not going to increase your limits. It's not going on top, but it's going to dovetail to provide you with, again, some of that broad form wording, and then that policy is going to exclude anything covered by the Fair Plan. There's still a couple gaps in there, so I'd recommend you talk to your broker about what that actually means.
Are you handling those types of dovetailing or additional policies now? Are you seeing that product actually available?
We are, but it's extremely bottlenecked. So we're having to bind California
So explain what
Fair
that
Plan.
means when you say it's bottlenecked. It's just hard to get it because there's too many people asking for it?
There's too many people asking for it, not enough underwriters.
So what's going to happen when that, you said that it's been increasing, you said 3 times the amount of people are using Fair Plan now. What's going to happen in the future as that number goes up?
Yeah, so the California Fair Plan right now is working very hard to get bodies trained in there to handle this workload that they, again, haven't seen before. So we are limited in, I would say that the California Fair Plan it's tricky because they're taking in so many policies. We've been on the phone for 2-3 hours sometimes waiting just to speak with someone. Sometimes it'll be weeks and weeks until we see a policy. Sometimes it's days. And then after we bind that policy, who knows until we get the wrap policy, which is, again, another expense because it's another policy. Mind you, you have to go get your liability policy. So it just increases costs and complexity, really, of the overall situation.
So can I drill into this just a little bit? Because one of the things you touched on, and this kind of follows on to the California Fair Plan question, which is there are two types of carriers in California, which is one is an admitted carrier, and one is a non-admitted, or what they sometimes refer to as a surplus carrier. So can you tell us, first off, what's the difference between surplus and admitted? And we're not just talking about the California Fair Plan, although it's become such a critical question in California because of all of this turmoil. So the difference between the admitted and non-admitted or surplus carriers, just touch on that a bit, and then how do they feed into the California Fair Plan dynamic that's happening in the state right now?
So outside of getting really creative with your insurance solutions like self-insuring and doing things like that, your three main options are going to be an admitted carrier, a non-admitted carrier, or the California Fair Plan.
Okay, just let me stop you real quick. What's the difference between an admitted and a non-admitted carrier?
Absolutely. So an admitted carrier is governed by the Department of Insurance here in California, and they're backed by the Guaranteed Fund. What that means is that in the event that the carrier goes insolvent, you're okay if you're with them because you'll get backed by the government as far as paying out your losses.
So that's the state of California that's the backstop.
That's correct. Now, there's going to be a few other nuances as far as how they write their policies. It's going to be on what's called an ISO form, which is a little bit more standardized. And again, their rates are going to be capped. And non-admitted, in contrast to that, you're not going to see any rates being capped in any way. They can write any specific policy on any form they want, so you need to be very careful about the coverages you see there. And then ultimately, they're not going to be backed by what's called SIGA, or the Guaranteed Fund there. So how do we mitigate that risk? Because we have clients that are very concerned about being in the non-admitted space. At Brown & Brown, we're not allowed to write with any carrier that's under an A- in their AM Best rating. And what that is it's a rating just showing the financial stability of a company. So you as a policyholder can feel comfortable that they're of a certain size so that the likelihood of them going insolvent is low. Does that all make sense?
It does. And I want to touch on, tell me about ratings. This is something that we see all the time. We're rated, C, B, A, whatever it is. For example, State Farm, or one of the big players, Farmers or State Farm, or what are they rated?
That's a good question. And it's something you need to know and something you need to continuously check on because the ratings are changing as things are getting hardened. So you really don't want to be with anybody that's not a A- or above, as well as a certain financial side. So you have the financial rating, which is a number after the AM Best rating. So you really want to be with someone A-, 7 or above. That's going to be important.
What's the problem with that? Like if you choose an insurance carrier that is rated like lower than that, is that going to just give you worse coverage, or it's just more risky, or what's the situation there?
Yeah, so this is extremely important when you're talking about lenders or contract requirements. So you'll see within a lot of contracts, they'll say in the fine print or in the insured agreement that you need to be with a carrier who is A or above, A- or above. So you can be out of compliance, out of contract, if you don't make sure that your carrier is sufficient for what's being asked of you contractually. As far as coverage goes, you might not see a change in coverage, but again, it's that stability, that financial stability of the carrier that you hope to be paying out your claims.
Yeah.
Just out of curiosity, this is a devil's advocate question. Have you heard of any of these companies not paying out because they go insolvent? Has that happened before in your career?
Not in my career, but it has in the past.
Really?
And that really moves into the larger conversation of the California Fair Plan going insolvent and what happens then.
Right. So that's a great segue into this, because I understand that one disadvantage with being involved with an admitted carrier is they're somehow related financially with California Fair Plan. So can you explain to me exactly how that works?
Yeah, so earlier we alluded to it a little bit, and this is the obligation that the admitted carriers have to the California Fair Plan, which, mind I say, the California Fair Plan is not a government entity, but it's backed by the government. And in the event that they go insolvent, the market share that you write as an admitted carrier, you have to kick in, you have to pay assessments to cover the losses. And and this is one of the reasons why, again, it makes it more difficult to write insurance here as an insurance carrier. Now, I frequently sit down with clients and speak about these things, and in the back of my mind, I'm always thinking, yeah, but what are the odds that they go insolvent, right?
Right, exactly.
Well, in the latest bulletin that was released by the California Department of Insurance, they just approved a $2 billion assessment that they're allowed to kick out to the admitted carriers, which, guess what? They're allowed to pass that cost down to policyholders.
Now, I understand that's a really one of these things that goes into the deep depths of the government. I understand that ability to collect, to pass that through down to the rate carriers is something that's very new and that was just passed in the state of California's legislature recently, like within the last 12 months.
That's correct.
That right?
That's correct.
Yeah. So why would you ever be an admitted carrier?
That's a good question. And a lot of it is just that comfort of being backed by the guarantee. It gives a lot of comfort to policyholders, and being on an ISO format simplifies things as well as far as policy goes. So those are some of the benefits. And I also want to clarify too, with the $2 billion assessment, there is so much nuance in how that's actually going to play out. It's not as easy as just cutting a check for $2 billion. It's $1 billion from commercial carriers, $1 billion from the personal line side. How they go about being able to pass that cost down is insanely complex, and these long format bulletins are coming out frequently and recently, as you alluded to. And it's an extremely complex landscape right now that I'm really curious to see how it's going to truly flesh out.
So one of the things that I keep hearing about on this is that this is something, I don't know, it just kind of comes through the general information stream that homeowners are going to get hit with a big assessment. Do you think that's going to happen, or what's your feeling on that?
I don't think so. I really don't think so. Now, what we can see is individuals that are with the California Fair Plan, we could see premiums being increased at renewal, but I don't foresee substantial fees being passed down, but we'll see. It's definitely a possibility, and again, they approve the assessments for it. So we'll see what those costs are. Yeah,
that's going to be really fascinating. I'm almost dreading, Michael's such a wonderful guy, but I'm almost dreading speaking to him next renewal because I got to hang on to the checkbook. It's going to be, I'm really hoping, Michael, that we can even get insurance next year. Do you think that's going to be much of an issue?
We'll have to see how it plays out. But I will say something that's interesting is a lot of times we sit down with clients and I get phone calls a lot of times asking for meetings to see how we can reduce their premiums, right? It's a frequently asked question.
So what do you say?
Yeah, well, it's funny because when we sit down, most of the time, we leave that meeting with them wanting to double their insurance. And the reason I say that is because when you start diving into the policies, it's fascinating how many individuals and how many carriers, how many companies are actually substantially underinsured. When you look at the cost per square foot nowadays in Santa Barbara County, we're seeing $800 per square foot.
That's such a great point, Michael. I'm so glad you brought it up because audience, read your policies.
Yeah,
I have bought policies from insurance companies. I'll give a classic example. We bought an E&O insurance, which we had been renewing for 20 years at like $15,000 a year, and I got the policy one time and actually read it, and it didn't cover. It excluded everything that we were doing as a business. I mean, I was like,
Yeah, I think I remember watching this.
Yeah,
Go
exactly. You remember how happy I was,
The
I'm
anxiety,
sure of that.
yeah, for sure.
Or you take a look at it and your name's not spelt right and it's the wrong address on there. And that's what we're seeing with a lot of policies that we interact with. They say, oh, we haven't increased our limits in 10 years. A lot's happened in 10 years. So, of course, there are other ways to save money. And I hate to say that you have to spend money to save money, but HVAC, plumbing, electrical, roofing, those are the key 4 things that underwriters are going to be asking about. So if you're on the fence of updating your roof and you're considering it, now would be a good time. And I'll also remind you to save your receipts. Underwriters are asking more stringent questions than they ever have before, and they want details of not just what year it was done, but what month, and who did it, and what did you do, and what type of electrical panel was put in. So there's ways to spend money, to save money. I wish I could tell you that it saves you exactly 15% on your policies, but it's all just a conversation with the underwriter. And then the second component of saving money really is trying to get creative with your insurance policy and the solutions that you have. We're talking high deductible plans, stop losses, things like that, self-insuring. But before you go down that road, make sure you know what the costs are going to be. I've seen and gone to underwriters and said, hey, what if we double their deductible, triple their deductible, and cut their limits in half? And they come back and say,
I know that's a question I asked.
Good job.
When we were talking with you initially, I said, what if I pick up the first $500,000? And it was interesting because it didn't seem to make much difference.
No. And that's why you have to be careful and understand what you're getting into and really calculate the savings. A lot of times, if clients ask me, hey, how do we save money? I say, no problem. It's really easy. We strip down all of your coverage and save you a ton of money. No one ever wants to do that, right? So it's all about value. You want to make sure what you're paying for is what you get, what you're getting. So at the end of the day, you can get creative on some of those solutions, but know what the savings are going to be and know what the risks are.
Mm-hmm.
Michael, one of the things that, and I'm going to have Hanna jump in here on this, but one of the things that we're finding with Pacific West is that it used to be so easy to get insurance for our clients that were borrowing money. So they would call up their insurance company, and then what we're finding, and this question, by the way, is addressing lenders for the moment. So we all have loans on secured by real estate, and one of the conditions of that is that they'll have insurance on the property. So what we're finding, and Hanna, you can jump in here anytime, but what we're finding is, the loan closes, the insurance is in place, and this is a follow-up question I'm segueing to, and all of a sudden we get a notice, generally at 3:30 in the afternoon on Friday, that the policy has been canceled for non-payment, or they've gone out, and after they've bound the policy, they go out, and 3 weeks later, they do an inspection, and they say, oh, well, this isn't what we were anticipating. So, as a lender, what do you do in that circumstance? What's the answer to that?
It's a really good question. And it's probably more even of a legal question in that sense, because what it might have to come down to is a forced placement of insurance, which is where you really don't want to go. It's not cost effective. And the best way to do that, the best way to move forward in that situation is to know your tenants, have good communication with them, be aware of the recommendations that the carrier is putting on them, which again is a fun word that they use, recommendations. It's really mandatory, or else they'll cancel your policy, like you mentioned. So getting those done in a timely manner really helps you to ensure that there's no lapse of coverage, to make sure that there's proper insurance in place, because I know that there's a heavy burden on the lender in that sense to protect the asset.
I've got a question for you, Hanna. I keep cutting you off here, but I want to ask you a quick question. What is the deal right now with getting insurance policies from these carriers? The actual policy. The actual policy. How long is that taking us now to get those?
Well, I'm kind of confused by your question.
So you did a thorough review of all our files. And didn't you tell me that some of these, we have, after even like 9 months, we still haven't gotten the actual policy?
Yeah, I mean, that's more of just I guess it's just difficult communication sometimes with some of these insurance carriers.
How long are you getting these on the insurance policies that we're doing right now? How long is it taking to get those policies, the actual written policy?
That's not so much the problem. I've found the complicated part of this is that a lot of these borrowers, because of cost, are going to multiple, like they'll do some coverage with one insurance, like they'll have multiple insurance companies they're working with. So it's just a matter of, I have more people to now reach out to get these insurance policies. It's not as much of like, it's that hard to
So
track
I don't
them
even
down.
understand what's going on there, Michael. What if we buy an if our borrower buys an insurance policy to get this loan in place? What's the deal with multiple policies? How does that happen?
It used to be really nice and tidy in a package policy. We're not seeing that anymore.
So that's referred to as a package policy.
Yep.
So
in the
you get-
past, right, is what you're saying?
So we still see those coming out every once in a while, but again, your admitted carriers, a lot of times they're going to be offering your property, liability, auto, excess. They can put all those things together, where nowadays, if you have a California Fair Plan plus a wrap plus a liability
Yeah.
policy, those are going to be 3 different things.
So
and
each-
mind
That's
you-
common. There's lots of borrowers we have that have 3 different
Really?
insurance policies that I have to. That's why it's more complicated, I would say. Not
Yeah,
so
wake
much
up,
calling
Mark.
them.
I didn't even know that was the case. So,
Seriously.
So you're getting. Oh, thanks. That was nice. Yeah, little dig there. It's really nice working with your children. I got to tell
Yeah.
you, Michael.
Oh, I can
don't
only
know if you
imagine.
have children, but you'll get to experience that. So Hannah, you're telling me that in our files now, sometimes we'll have 3 or 4 different policies for the same borrower.
Yeah, and that's also if that's just one address. So lots of borrowers have multiple addresses.
And
so
they have
there's
different carriers.
Yeah, for
and
each
they
one.
in turn have 3 or 4. Wow.
And mind you, the California Fair Plan doesn't release certificates of insurance. So
Yes.
you're going to need the
You have to
policy
track them
there with
down.
the, and
But how
it's-
long is it taking these guys to get, here's the thing about being a lender, right? So, or anybody that's in a position that's relying on someone else to have insurance. So you're going to close the loan, and then you ask for evidence of the insurance. Now, let's say they're going with California Fair Plan. So what, I'm sure the state of California isn't running down and delivering that policy to you in 24 hours, right?
No.
So how do you, if they're not doing certs, what do you do?
So it's all about dealing with the lender, and some of them they set the bar a little bit lower, and some of them set the bar a little bit higher.
Well, let's say it's Pacific West, because we set the bar as high as it goes.
That's
So
right.
Then what?
So what you can ask for with the California Fair Plan, it binds when you pay for it. So the day you pay for it, it'll bind the next day. So that day you could ask for proof of payment and
then
ask for them to send in any binding documents, any policies that they have, especially when they get them. Now, again, being a lender, you want to be aware of what they have if it's just the California Fair Plan.
So can you arrange, I'm so glad that we're having this conversation, because I just learned something right now that's just invaluable. If you're a lender, I don't know if you just heard what he said, but they don't provide certs, they don't provide policies, but it's technically qualifies as being bound when the payment is accepted.
That's right. And they will release a policy. So the matter of when that changes, but you can receive the policy from them. Again, remembering that every policy is the same for the California Fair Plan, essentially. There's some coverage extensions they could have purchased or not purchased. But as a lender, what we're seeing a lot is they're requiring, again, special form, broad form. They're not asking for named perils. They want more than the California Fair Plan. So they want to see proof of that wrap policy that we talked about.
And how long are those policies or certs? They do issue certifications, though.
Yeah, you can, but again, we're binding California Fair Plan policies and waiting weeks and weeks to get a quote for the wrap because of that bottleneck, because of the lack of underwriters on that side. So it's an insanely challenging marketplace right now
So
to be
how are you
timely.
dealing with that as an insurance agent? If somebody has, let's say they have an insurance loan, right? So from a major insurance company, generally those lenders tend to be just fanatical about all the stuff that you have to have. It's pages and pages and pages. So what do you do in a circumstance like that? The borrower or the owner of the property's policy's been canceled, and you go to the insurance company's loan servicer and say, hey, I had to scramble. I have California Fair Plan and I'm getting a wrap. Are they being accommodating right now, or what are they doing?
Yeah, it's a good question. A lot of times what we do is we'll pick up the phone as the broker and have that insurance conversation. And again, it depends on the lender that we're talking to, how lenient they're willing to be. But a lot of times we're willing to pick up the phone for our clients to do that negotiation on their behalf, see what they're requesting, see if we can get there in some combination of ways, combination of policies. But one of the excuses that a lot of lenders don't like is it's too expensive, because they're willing to, we'll be able to offer quotes from a non-admitted carrier. It'll just be 3 or 4 times more money. So it's a tough balance of whether they're willing to play ball or not.
Yeah. Well, that's really interesting. And, just a 5-second commercial for Michael. You touched on something that was really hit home with us. Before we switched to Brown & Brown, we were working with a local company, and we started reviewing all of our policies, and I would say 35% of them didn't even have our office address correct.
Or Pacific West listed.
Or Pacific West listed.
I was actually going to talk about that as well. Like when you don't, like if it takes a long time to get the certificates back and Pacific West isn't listed, which I've also run into on like Fair Plan before, then, or the address is wrong or something. Like, surely that's a big problem with like your own, like our back. Like, is that not going to affect us down the line?
Yeah, so you always want to get the blocking and tackling right. Back in the day, we used to be able to sit back and talk about different specific coverages, increasing sub-limits, and doing creative things on the coverage side. Nowadays, we want to make sure that those things are right first and foremost. We talked about limits with square footage and cost of construction, and those things that fall in line with that. We have to have the right named insureds. We have to have the right additional insureds. We have to have the right mailing address, locations on there. We want to make sure all those things are dialed in.
The insurance world has just completely changed in the last couple of years. I noticed it about 2.5 years ago when we started renewing these policies. Like, what the heck is going on here, And then we really started having to dial in on all the paperwork and making sure it's right. And boy, if you're out there and you're buying insurance, you better be paying attention to this stuff.
Yeah, you said it well, Mark. At the end of the day, you don't need to know everything about insurance and your policy, but someone does. So you need to make sure that you're protecting your assets in such a way that there's transparency and you know what's covered, what's not covered, because insurance is just risk transfer, and it just needs to be transparent as far as what you are transferring and what you're not.
Exactly right.
So, yeah, it's a crazy time in the market right now, especially with all the bulletins that are coming out. Like I said, things are changing weekly, and I would encourage anyone out there to also sign up for the California Department of Insurance to receive their bulletins.
We get those now, and they're quite interesting on what's going on. It's so funny because insurance is like one of these topics, that, and you see these in the comedy show and everybody falls asleep the minute they're talking about it. But what's scary is they're doing these interviews with these homeowners up in, the Eaton Fire or the Palisades, and some of these people don't have insurance. And it's like, man, I'll tell you, that'll ruin your day. Yeah,
absolutely will. And we'll see what's going to happen in the future. Ricardo Laura put forth a sustainable insurance strategy that he's taken a while to put together, and it just finalized in 2024. The last thing that they just came out on that was they want, if they're going to agree to rate hikes for these insurance carriers, well, the insurance carriers have to write up to 85% of wildfire risk and a stair-stepping of 5% each year. What exactly does that mean?
Yeah, I was going to
say, man, you lost me.
Yeah, I don't know.
We will see. We're still trying to figure out what all of it means, and at the end of the day, it's contingent.
What do you think that means?
What it means is they don't want the carriers coming back in the marketplace and cherry-picking all the best risks because they know that they can undercut the premium.
Yeah.
So Ricardo Laura, he's got a really interesting balancing act right now of trying to be a consumer advocate, but at the same time, keeping the carriers happy so that they'll come back in, right?
Yeah.
So he's trying to find a way to allow for rate increases but they're going to have to commit to writing a certain amount of wildfire risk from the California FAIR Plan, because again, it's not supposed to be a permanent solution.
Who's the biggest carrier in California right now? Admitted carrier. Do you know?
That's a good question. No one wants to be.
No one wants to be the biggest, or no one wants to be an admitted carrier?
No one wants to be the biggest because their market share is going to determine how much they have to pay out in the event that they go insolvent. So it was a real race to try to shrink the market share.
Really?
So that's, and again, it's all contingent on whether they want to play ball or not. So if they want to come back in, they're going to have to be writing some substantial risk. And again, that's with rate increases. So at the end of the day, the costs are going to keep going up.
The risk thing is really fascinating because I think it was General Re or Swiss Re announced today that the fires in California are going to cost them. This is the reinsurer, so they're not even the first guy to pick up the check. Is like 1.4 billion just from one reinsurance company. So that is just going to percolate out through the whole system, I think.
Yep, absolutely, absolutely.
So just backing up to the question, who are, say, the big three in California right now? If you're trying, let's just concentrate for a moment on commercial insurance. If you're trying to buy commercial insurance, are there any admitted carriers in the commercial market?
Some of them would be willing to write it, but you have to be a perfect account. It's got to be very, very clean. They're going to be asking very stringent questions.
Like, what's a perfect account? Describe a perfect account.
Yeah, so it's going to be, again, focused on those four. They're going to have updates, recent updates on the HVAC, plumbing, electrical, and roofing.
Okay, so let's stop you right now because you've mentioned this twice, and I want to make sure our audience hears this.
Yeah.
There are four things that these insurance companies look for: HVAC,
Yep.
plumbing, roofing, and electrical.
Yep.
Okay, where does like fire resistant, like sprinkler systems, stuff like that, like come into play there?
That's a good question. It depends on the underwriter. So on top of those four things, they will also ask, are there any safety or burglar alarms? Are there any fire alarms? Are the buildings sprinklered? And all of those things matter, but the story has to be told. So if you have central fire alarms and your buildings are sprinklered, it's only as good as that gets transferred.
So it's like what you need to disclose to them. They're not necessarily going to be able to figure that out for themselves.
Some will go on inspections, but you want it earlier
you
than
want
the
it
inspections.
Like out
you want to make
the,
sure that it's impacting the quote that you're receiving.
You know, I'm going to jump in here because with Granger the Granger company, property management arm, what we've been doing for our clients is putting together what's called a property profile.
Yes.
We take pictures. We have all the, when was the HVAC put in?
And
when
major updates on that stuff as well.
Exactly right, Hannah. Yep. So major updates. When was the electrical redone? Plumbing, anything that has to do with the mechanical or the general condition of the property. And we take, for each property, we take 30 or 40 pictures. And when you were shopping for us, we had a package on every building like that. And audience, Granger Company is available for property management, but you should be doing that when you talk to your insurance agent because it gives them the tools to go to the market and do the best they can for you, right?
You found that gave you better quotes?
I think the answer was it allowed us to get quotes.
You know what happens a lot of times? I send an email out and I say, hey, can we get the latest updates on those four things? And it's silent, and it's silent. And then I get an email back saying, oh, I think we did something in 2004. Then I follow up and it's silent. And all that it does is all the carriers just decline the risk. And then I have to go to the one or maybe two carriers that will accept the risk with no updates.
Yeah.
Okay, there's not going to be any competition. There's going to be no negotiating for pricing. So what you provide with that packet, it's really a broker's dream because then I can go out and...
Like cheaper and better coverage.
Well, you're already anticipating the questions that you're going to get asked already. So I can be upfront with that to where the underwriters are humans too, right? If they see an application that's 50% complete on their desk, they're not going to pick that up as opposed to one that has a full packet with photos and updates. So it's making yourself way more attractive to the marketplace, which allows you to have more quotes, more negotiation, cheaper coverages.
Let me tell you, Michael, a follow-up, and you don't know this, but this is interesting. We had a policy that you wrote on a building that was built in 1920. It's the oldest building in Torrance, or second oldest building in Torrance. And, you know, we got it through by the hair of our teeth, as they say. But the carrier called us back. They had an inspection, and then they had a service. They had, like, I don't know what they call these people. They're like the servicers or something for the insurance company. And she said, I need you to address these two questions. One was they had some sub-switching gear that was made by Siemens, and they don't carry policies that have that switching gear.
There's a recall on that for that year.
So let me tell you the story, though. It's really interesting. She said, I have told this carrier that you guys run a really tight ship down there and that you have already provided us all this information. And I've told them that, don't worry, they'll get right on it, which we did. That day, we sent pictures in and we said, yeah, this has all been cleared up. The problem went away. But you could just see, if you're not on top of it and you don't come across as like knowing what you're doing on the insurance, boom, they're looking for a reason to they're on a hair trigger right now. And
on that story, that was a notice of cancellation. They were going to cancel the policy because you had that breaker. Right. And that was, you know, me going to the carrier going to the third party to try to find that out, who already did the inspection, but then they're asking us for the code on there because the inspector did. It's a lot of jumbling of playing telephone here through a bunch of different people, but you guys were able to quickly do it that day, and lo and behold, it wasn't the model, and they switched it like that because you guys got back to us so quick.
They turned off the problem.
Yep.
By the way, if you have, I know that Pacific West we buy a lot of the force-placed insurance, right, Hannah? I mean, we're always doing that, it seems like.
Pretty often.
Yeah. Which, by the way, force-placed insurance only covers you for fire. That's it. And it is, I would say, 5 to 10 times more expensive than anything else.
That division within Brown & Brown is absolutely blowing up.
It's really important, audience, if you have a restaurant, for example. We had this came up too, that they said, hey, you know, your restaurant's a little dirty, we're concerned about a grease fire.
Yeah.
So this is the kind of stuff now that these insurance companies are drilling into in terms of getting into your business. They're saying, hey, you want us to take your risk, you better be a good customer, and we're going to start really paying attention to you. And we never, ever, ever saw that 3 years ago.
Why are we seeing increases in premium? There's no, it's all about supply and demand, right? And there's no competition, and it's allowing these insurance carriers to sit back in their chair and say, hey, we want these 20 things and we want it by tomorrow, and oh yeah, it's still going to go up 300%, but you renew tomorrow.
But you'll get the insurance.
But they know that they're the only option, so they're asking more stringent questions. You brought up a really good point about tenants. I'm asked more questions about the tenants than I am of my clients. They want to know what the tenant's doing, how they're doing it, how long they've been in business, what are they storing, what are their operations like, and that's having a huge impact on premiums.
And you know, they used to say, oh, well, we're going to do an inspection, and then they never did it. Now they do them.
Oh yeah. And
they're out there.
Yep.
And you know, the inspectors are, you know, of course, all over the map in terms of their quality and stuff, but
well, there's not enough inspectors. So they're, you know, the third-party inspectors that they have, exactly, they're not exactly quality, and it's creating a lot of confusion as well as to what exactly needs to be done.
So Hannah, I want to talk about the force-placed insurance market, because if you can't get insurance, what's the procedure for force-placed insurance now? What's the deal with that?
Like, what do I do step by step when I need to get...
I want to hear exactly what you do. Our audience wants to hear exactly what you do.
Okay. Well, I will usually try and get the borrower to, you know, renew their insurance, which is usually their problem. They just don't pay it, or they intentionally don't pay it because it's really expensive.
Or it's canceled.
But, I'll have to fill out a form and kind of go back and forth with the forced insurance. Honestly, I don't really know exactly who's on the other line. It's usually like over email that I'm doing this. But
tell me some of the questions they're asking you. Like what kind of stuff are they going to ask you in a
like situation? The property layout.
Do they ask who's in it or what they're doing, or they don't care?
Well, I mean, I imagine more with like the tenants, but usually like the people I'm interacting with are the borrowers, and they're usually more of like it's not like an apartment well, I guess it is sometimes. It's more of like an apartment that has tenants situation, but most of the ones I've done have been like single family residences or I don't know, like industrial properties. So it's, I mean, I usually keep that information in like our database. So I just will usually just provide whatever I can about that. And it's not so complicated getting them the information. It's just like the back and forth of like the questions they ask.
And it's just it's an informational gathering situation, and then they'll. So apparently they're a lot easier to work with, right?
To obtain forced insurance, yeah, it's going to be a challenging market, and again, it's going to be
so let me just be clear on this, because we've never had any problems getting forced placed insurance. When I say forced insurance, right? That's the term.
Forced placed insurance.
Okay, so forced placed insurance is the absolute last resort. If you can't get insurance anywhere else and you want to make sure that place isn't going to burn down, that's where you go.
That's where you go.
Okay,
That's
and
correct.
you guys handle that.
Not our office directly, but Brown and Brown as a
an
whole
entity
does. We have that division.
Okay.
I think you think that I like have to do that more than I actually do, but usually when
It seems like we're doing it all the time.
well, like the possibility of it, but
Yeah.
Well, it seems like we're dealing with it.
I don't come across it at all.
Well, in the lending side, we do,
Yeah.
because what happens is we're not in control of the insurance.
Totally. You
Yeah.
can't force them other than
Well,
force placement through
What
this.
we can do, well, here's the problem for a lender. You make the loan, so now you have, for all practical purposes, you own a portion of that property, so indirectly, of course, through the loan. But if it burns down, your security is greatly impaired.
Yeah.
So for us as lenders, it's really extremely important that we have protection against, most importantly, fire. That's the big one.
Yeah.
And so what happens with that is that we're put on notice often by the carriers. I was joking earlier. Why do insurance companies always cancel their policy at 3:30 in the afternoon on Fridays? But the problem is when they do that, you got to jump on it. And I say, Hanna, get on it. And that's what we have to do. We have to call the forced placed insurance company and say, we got to have this policy bound like Monday morning.
Yeah.
And that's, I don't know if many in our audience know that this is even available. A lot of people aren't even aware that this segment of the insurance market exists.
Yeah.
But, as a last resort, if you've gone through every option to get insurance and you can't get fire insurance, give Michael a call and he'll get you in the right avenue, the right channel for this forced insurance, which you may not want to keep it in place too long, but at least you'll have coverage for fire, right?
Yeah. And going off the script a little bit, I know you know more about this than I do probably, but
probably more than anybody wants to know
yeah,
is
but
the answer.
How does it impact how you drop the lease, right? Because if they have a triple net lease, then they're going to be responsible for the insurance instead of you taking hold of that and being able to place it.
Okay, so we run into forced placed insurance mostly through the lending business.
Gotcha.
Okay, so that's a situation where somebody's borrowing money from us, they've let their policy drop for non-payment or non-renewal.
Yep.
And then we get the dreaded notice in the mail that says, hey, your insurance is out of whatever they call it, ineffective or whatever the term is on Tuesday. Just letting you know as a friendly reminder. And
people will usually wait until pretty much the last minute. But I was saying before, we don't actually have to do forced placed insurance that often, because usually just like the threat of it, I guess that's a bad way to letting the borrower know it's really the cost of it mainly, they'll get on it pretty fast. So
once we call up our borrower and say, oh, by the way, your insurance is lapsed, and on Tuesday we're going to put new insurance on, and it's going to be 10 times what you're accustomed to paying.
Yeah.
And by the way, we also we have no choice but to do it, and we
Yeah.
have one carrier out there that will do this, and your insurance was $5,000 a year, and now it's going to be $45,000 a year.
No, they care about the cost mostly, obviously.
Yeah.
Right.
So
Yeah, and that's up to you as a lender of what you're willing to accept. You know, that we're talking about worst case scenario, but how do you feel about the California Fair Plan? You know, how do you feel about certain coverages and limits? And but yeah, certainly last case scenario would be forced placement. And to your point, a lot of those emails will usually get them
Yeah.
in step. Absolutely.
So just to, I wouldn't say wrap up necessarily, but we're seeing all this turmoil and so on. Do you think it's possible that we're seeing I wouldn't say a nationalization of insurance, but is this going to become a government deal now where carriers you might get like these specialty policies from insurance companies, but the main insurance is going to be issued by the state of California. Is that a possibility?
Yeah, there's certainly a lot of speculation about that could potentially be in the future. I don't foresee it happening.
Why not?
Well, we just finalized and ratified the final steps of California's. Ricardo Laura just finalized the last part of his deal in 2024. So I think it's going to take some time to see if that's actually a solution to the marketplace here. We're still going to have non-admitted carriers that are going to be willing to offer policies, again, at a rate you don't want to pay, but nonetheless are there. Mm-hmm. So I think it's too early to say that because we need to see the impact that the plan that he put forth to see if that has a true impact of bringing back insurance carriers into the market. And before the LA wildfires, we were starting to see premiums start to stabilize. We were starting to see very slight reductions for the first time. It was a very exciting feeling. Next week, the LA fires happen. So I could foresee us stabilizing in the future, and obviously that's the hope.
So, Michael, we've covered a lot of ground here. I want to thank you so much, and Hanna, thank you.
Thanks.
It's always a pleasure to hear from someone on the front lines of actually dealing with the fire and the fire insurance and all the insurance stuff. Audience, Michael Esparza has come down specifically from Santa Barbara, which is hard to leave, I'm sure of that. From Brown & Brown, they've just been so instrumental in getting us through this problem. I want to thank you, Michael, for coming, and I also want to urge you that if you do have questions, visit our website. Michael's information will be on there. I think you're still taking new business, right?
Oh, yeah.
Okay,
Oh, yeah.
So Michael is open for business. If you have an insurance question or have an insurance problem, please give Michael a call. And Michael, again, thank you so much for visiting us, and we'll talk soon. We'll talk again. I'm sure I'm sure this problem is not over. So hopefully we'll have you again into the studio.
I
so
look
thank
forward
you
to
very
it.
much.
Thank you, Mark.